A wonderful good day to you. This is Owen McCafferty again, speaking on behalf of Professional Fusion. And our focus in this channel is to provide you with usable information of what's occurring in the real world instead of some theoretical application. And this discussion relates to a question that was posed to me no more than 5 minutes ago by one of our sterling CPAs in our accounting firm, Owen McCafferty CPA Incorporated, on the issue of a client purchasing life insurance. So the issue is life insurance and mortgage loans. Let me set everything up. Often, what occurs in veterinary medicine, and in this case, dentistry, or in dermatology, because I have clients in all three that have put up absolutely phenomenal buildings. These buildings were funded through the judicious generosity of a bank that loaned them a good amount of the money, usually 80%. And the bank wants to be indemnified every way to Sunday. These are not folks that are risk takers. The greatest task of any banker is to stay employed. So they want to have indemnification. They want to be careful that the money that they're loaning to you is going to be paid back. Now, in a profession such as veterinary medicine or dentistry or dermatology, the individual that borrows the money, that puts up the building, that is then leased to the operating professional practice, is wholly dependent on the success and the competencies and the hard work of the principal who's putting up the building that just so happens to be the key and principal doctor of either veterinary medicine, dentistry, or dermatology. And they've designed a building that is unbelievable. Every accommodation known to God and man, HIPAA compliant, everything is in perfect order. For example, with veterinary medicine, if it's a mixed animal practice with canine, feline, ovine, porcine, bovine, you're going to have a different design for the hospital than if it was a strictly small animal general practice. And that would be different if you were having an emergency clinic, possibly with specialists such as dermatology, ophthalmology, surgery, radiology, all of the professions that would occur in veterinary medicine. The designs of each one of those buildings would differ. And as a result of that, they become what are known as unique structures. Same thing holds true in dentistry. You'll have operatories designed, you'll have a lab facility, you'll have meeting rooms, break rooms, patient consultation offices, usually with a flair towards setting up financial plans. And in dermatology, you're going to have a whole variety of different things. You'll have surgical suites for Mohs, surgeries. You could have general examination rooms. You could have spas. All that could be put into the design of a building. There's unique structures with each. And as a result of that, they will be not valued in the same manner. The cost to construct one of these beautiful palaces is going to be far greater than simple office space, such as the office space that you see that I have, that is multi-purpose. And as a result of that, the bank will be a little edgy because they're kind of scared. Gee whiz, if something happens to you, then who's going to take over? And how are we going to get paid? So bankers are risk adverse. And they've got money and they want to be paid. They charge a usurious rate and they want both the interest and the principal to be paid back. So let's start the what would happen ifs. What would happen if you die? Well, then there's going to be insurance. the bank will want that insurance pledged to pay down the proceeds on the loan that will be due. So if, let's say you put up a building for $4 million and you've got a mortgage outstanding for about $3 million, you paid a little bit down on principal. And they're going to ask that you have a life insurance policy at the start of it, probably for $3.5 million. And they want to make sure that they are going to be paid first. So they want the proceeds pledged first to retire the indebtedness on the building. Now, some of the banks will go a little bit further. They'll get a little wacky in their old age. They'll want to be named as the primary beneficiary. Well, you don't want to do that, because often what you're going to do is you'll hold the loan for a while, and then after the period for penalty has been eliminated, you may look at trying to refinance the loan with another financial institution. Why in the world do you want that bank to be the primary beneficiary? You got to go back and you got to change it again. Here's a better idea. If you are married, make your wife the beneficiary of the policy as the primary beneficiary, but pledge the proceeds to the bank while there's still a loan outstanding. When the loan is satisfied or you refinance, then there's no need for pledging the proceeds, and it just evaporates. But don't make the bank the primary beneficiary. I just went through that with a client. They didn't ask us, they didn't call us. Those are two big mistakes. What we would have done is told them, well, make your wife the primary beneficiary. So those are very important things. And it's important that you have that kind of activity in place. So that's one tip on insurance. When you get insurance and you know there's going to be a need for it, pledge the proceeds to the bank, but not as a primary beneficiary. Instead, what you want to do is just make sure that that primary beneficiary is your wife or another person if you would so choose. But 99% of the times, if you're married, your wife will be the beneficiary of the policy. So that's one coverage. The second coverage that you don't see as often, but still does exist, is disability insurance. Now, that's very, very expensive, because the probability of disability within the terms of the loan are far greater than the probability of death. And I think banks are reaching a little bit too far if they require that you have disability insurance. And you can quote me on that. Because if you do have disability insurance, you're still in the land of the living. And you still, if you're disabled, you can still make good business decisions. So it's not like when you die, the entire asset base is then in the hands of maybe a person who doesn't know what they're doing, maybe a spouse, maybe another executor or executrix of the estate, if you have that administrator, or another person who would then be named to manage it, will not do as good of a job as you, because you're licensed. You know what the demands and the needs are. So the building itself is in far safer hands when it's in your hands. That's why I think it's very reasonable for the bank to require there to be life insurance. When you're younger, that life insurance is cheap. Now, when you get older, it gets a little bit more expensive. I still carry life insurance on my life. And as you age, it becomes more of an issue. Perhaps you want to buy a longer term insurance. Now, you might say, well, the mortgage is only going to be for 15 years and it's on a decreasing term basis. Therefore, I'll buy a couple policies and I'll just eliminate one policy at the conclusion because I can get it a little cheaper. That's a fine idea, but what I will tell you is that as you age, grade, punch, and ball, you would think that your obligations diminish. And take it from me, they do not diminish. They accelerate, they accumulate. There's a parabolic increase. It's not even linear. There's a lot of things that happen in your life that certainly are not as a result of your activities, but people who are affiliated with you or beloved ones that are in special needs. And in those cases, you will need insurance because a lot of people might be depending on you. So when the bank says you need insurance, remember, pledge proceeds to the extent of the loan, that's reasonable. Don't put the policy in the name of the bank because you may not be dealing with that bank forever. And remember that longer term insurance, well above and beyond the term of the building, might be more prudent. In fact, you might even look at some sort of whole insurance possibility. Now, you might look at universal life or variable life. That's beyond the scope of this discussion. And an insurance professional would be a good person that should work with your CPA and your attorney because there's an estate issue on this in order to come up with the most sensible and simple solution. Don't get fancy. Laws change. We just saw one big, beautiful bill pass for 2025, and there's going to be another change. Maybe it's not the change to end all changes as some have billed it. All I'm saying is know that insurance is a good idea. My personal opinion, I think that professionals in total are way underinsured. When you look at insurance, don't just look at insurance for yourself, but look at it for your spouse too. Because your spouse has major contributions to the family that without your spouse, you would have a tough time trying to fulfill. We'll go through a whole slew of a lot of different issues, but for now, what I want to do is merely to remind you that it is an important and a good thing to use the insurance as a way of guaranteeing, but then to look at what your insurance needs would be thereafter. Incidentally, if your practice pays for the premiums on a life insurance policy and the beneficiary is either the bank or your spouse, that payment is an advance from the practice to you individually as an employee / shareholder. So you have to pay that back. It may be for the building that you're renting, but the beneficiary is a personal beneficiary. In the event that you take out insurance and the entity that takes out the insurance is the entity that holds the asset, which is usually a separate limited liability company, you have to look and see, number one, who's the owner and who's the beneficiary and what the intent is. If the intent is that the proceeds would go to the beneficiary and you're the owner, then that becomes, again, an advance from the limited liability company to you. So you got to book these things correctly, and you have to know exactly where they sit. Don't confuse this with officers' life insurance, where the beneficiary is the corporation, where the owner is the corporation, and where the insurance that is used could be used to fund a separate obligation of the corporation, such as a deferred compensation arrangement not qualified to you, or possibly as uh, a policy where the proceeds would be used to provide a benefit to an employee, because they worry that if you die, what are they going to do? They invested their entire life devoted to your practice. So there's a whole slew of reasons and logic why insurance is a great idea. I personally believe that in the United States, we are underinsured. So I'm sure most life insurance agents will want to keep a copy of this specific broadcast. But it is an important issue. Being a doctor, you have obligations. Just have to know when and how to use them. Well, with that in mind, just want to say thank you very much. This is Owen McCafferty speaking on behalf and through the generosity of Professional Fusion. Hope to see you at some point in the future. Take care.